Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is July 17th edition of Market Outlook. So, first thing to note, of course, is that we had some pretty powerful moves across the board. The key indices regaining its composure, specifically NASDQ. So, a couple things here. As you can see, this is our NASDQ 100 chart, and we had a really nice size rally breaking out over a key resistance point that I had pointed out, which was 140. So with that, we're actually approaching the all-time highs, which occurs just above where we are. But since the big down day when the semiconductors got really clocked, we've actually had our highest close on Friday, taking out all of this action in here. So the first line in the sand, of course, was our 50-day moving average and this resistance level from several days of trading and where the market broke down from. So we definitely cleared all that and now closed. And you've had its highest close now since the big breakdown, and that's pretty important. The other thing, of course, is Dow, which had been noted as our strongest index, actually ended up on new all-time highs, along with the S&P. Our real motion indicators show that the Dow has regained its composure above our short-term or our 50-day real motion indicator, which is a positive. So net-net, you can see tremendous improvement across the board, right? The SPYs, the Dow closing on new highs, compression in IWM, sort of in a pause here. What we really want to see is it break out above this upper part of the channel, and of course, looking for NASDQ to break out to new highs as well. So the important things to watch are the gap days. If this is truly a important gap, we want it to hold, and that's pretty much across the board in the S&P. You've got a gap, and in the Dow. So those are two important gaps to hold. If they break and fail, it could be a potential of the false breakdown or breakout. So those are your important levels to watch. Now, in terms of the overall bigger picture, key relationships in the market, one thing you can certainly see is that the S&P versus the conservative plays like utilities, S&P continues to gain on utilities. That's a positive sign. Risk on is definitely lit green. Let's take a look at some of the other indicators as well. And so what we do, we compare several other key market relationships, and so versus bonds, steady improvement in the S&P. Bonds versus high yield debt, definitely improving as well. So that's on a buy signal. And the S&P relative to gold, which is your anxiety indicator, also improving. And of course, gold versus wood, lumber, which represents construction and the housing, lumber is definitely outperforming. So net, you can see with this breakout in the S&P, back above the 50-day moving average and above the 10, and breaking out of this trend line here that had been in place since early June, is all positive. So in essence, our risk off, risk on gauges are lit up 100% on the positive side. And remember, it had been lit up now for several weeks, mostly positive, and 100% positive last week. And that was a good indication to us that even though there was pressure in NASDQ, and we were not sure how that would resolve, that the risk-on indicators definitely took the lead role, and the markets actually responded well to what those indicators were saying. So in terms of the sectors, again, the good news is that technology, growth stocks, definitely retained its leadership. So you can see on this page here, our sector summary page, sectors that were leading: semiconductors and technology, up over 3.5 to 4%. That's a really positive sign. The other leading sectors was basic materials. So that is commodity related. So there's definitely a pickup in commodities. Copper has been acting well and looks poised to take a move to the upside as well. And of course, right here you can see utilities, conservative play, definitely lost ground. That was only up 0.8%, where the S&P was up 1.4. So again, the conservative plays losing ground. That's all a positive. So sector summary looking really good here as well, and we're getting the leadership that we want. And growth stocks, again, retaining its lead. So in terms of volume, another good improvement here as well is that you can see that where the NASDQ had multiple distribution days, and we had not seen any real good move to the upside in terms of volume, everything now has flipped around, with the exception of the Russells, but still neutral. So you can see here, net, more accumulation days than distribution days across the board in all the indices. That's a positive. Have we gotten a full-fledged huge buy signal? No, but that's not unusual during the summer months. And as you can see, up almost 20% in NASDAQ year to date, and hitting good almost 10% in the diamonds, or the Dow and the S&P 500. So net, all around good improvement. So taking a look at more of the global markets, a couple of things to note. One, commodities definitely are getting some attention. Coffee, which has been down sharply, had a really strong week as well, up over 4%. Another thing to note, solar stocks really coming on strong, not quite the absolute leading sector in the market, but coming close now. Definite big improvement over the last 3 months. You can see up over 18%. That is a really good move here. So what's interesting is, even though oil is basically just bouncing off of its lows, solar is really much stronger. And that's in spite of the moves by the Trump administration to try to focus on coal and some of the older energy sources. So solar taking on its own role and moving up strongly. So the other thing to note is that the dollar, right, had a really weak performance. What's also interesting is both the dollar and the euro are approaching critical levels on weekly charts. So going back several years now, the dollar, if it takes out its 200 weekly, which I'll update you on when that occurs, would be a really critical long-term trend change. Shorter term, we already have moved away from the dollar into other currencies, and specifically the euro. The other thing to note is that some of the leading stocks, which had been Europe, have been replaced by Asia, India, and Korea. So you can see really good moves over the last couple of weeks. Korea, EWY, really strong, up over 5% for the week, along with India up over 3.6%. So what's happened is money has shifted out of the Eurozone and more into Asia. So that's something to note. Our models have definitely picked it up. By the way, if you're interested, we've had some extraordinary performance in our ETF models. Please give us a call and we can accommodate you if you're interested in trading quant-based models that take advantage of these global trends. All right, so overall, equities markets look intact, certainly in the US, and money moving into Asia as well. And watch commodities. They look like they're potentially coming out of a long-term base. And remember, on a relative basis, commodities haven't been cheaper in many, many decades. All right, that's it for now. See you next week, and good luck with your trading.